You've heard whispers of a slowdown, but this just made it official. Zillow, one of the biggest names in real estate data, has slashed its 2025 housing market forecast. Their prediction for U.S. home value growth has dropped from 2.9% to just 0.6%. But that's not even the real shocker. According to Zillow's latest update, 242 U.S. cities are now at risk of home price deflation, meaning values could actually go down in the coming year. In a market that's been white hot for over a decade, this is a massive shift. And if you own a home, want to buy one, or are thinking about investing, this could be your wake-up call. Why is Zillow pulling back so hard on its outlook? What does this mean for your city? And should you be worried or preparing to pounce? By the end of this video, you'll understand where the market is heading, which cities are in the danger zone, and what this means for your wallet and your next move. Because one thing is clear, the days of non-stop home price growth might be over. So what changed? Just a few months ago, Zillow was predicting that home values across the U.S. would grow by nearly 3% in 2025. That's modest, but still positive. Now, they've pulled that back to just 0.6%. That's barely above flat, and in many markets, it's already tipping negative. According to Zillow's analysts, several key factors drove this sharp downgrade. First, housing inventory is rising fast. In February 2024 alone, the number of homes listed for sale surged by 12% year over year. More homes on the market means more choices for buyers, which puts downward pressure on prices, especially in areas where demand is cooling. Second, affordability has hit a breaking point, with mortgage rates hovering between 6.5% and 7%. Monthly payments are crushing budgets. The typical American household now needs to spend over 38% of its income just to afford the median home, far above the historical norm of 30%. And third, buyer demand is retreating. With fewer buyers competing, sellers are being forced to drop prices or offer concessions just to get offers. Zillow's model is adjusting to these realities. It now predicts that a growing number of metro areas will experience price declines, especially those that saw unsustainable price growth during the pandemic housing boom. This isn't just a nationwide slowdown. It's a local correction, unfolding in specific markets hit hardest by affordability pressures, overbuilding, or economic slowdown. Bottom line, Zillow's revision isn't just a small adjustment. It's a signal that the market is undergoing a serious shift. So where is the deflation actually happening? According to Zillow, 242 cities across the U.S. are now projected to see home prices decline over the next 12 months. And we're not just talking about small dips. Some cities could see drops of 5% to 7% or more. Let's break it down. The hardest hit areas, smaller, mid-sized markets that saw explosive growth during the pandemic, but now face a harsh reality check. At the top of the list is Houma, Louisiana, where Zillow expects home values to fall by a whopping 7.3%. Right behind it is Lake Charles, Louisiana, with a projected 7.0% drop. These aren't random outliers. They're canaries in the coal mine. Local economies in these areas are slowing, insurance costs are rising, and demand has dried up. The trend continues in parts of Texas, Florida, and the Midwest. Cities like Abilene, Texas, 4.5%, Cape Coral, Florida, 3.8%, and Rockford, Illinois, 4.1%, are all in the red zone. Many of these areas became hot relocation spots during the pandemic. But now, with remote work plateauing and interest rates soaring, buyers have backed off and prices are sliding. Even some larger metros are at risk. While places like New York and San Francisco are more insulated due to limited supply, Zillow is flashing yellow lights for cities like Phoenix, Arizona, and Boise, Idaho, where price gains from 2020 to 2022 were simply too fast, too furious. On the flip side, Zillow still expects some metros, particularly in the Northeast and Midwest, to see modest price growth. Cities like Buffalo, New York, Indianapolis, Indiana, and Chicago, Illinois may hold steady or even gain slightly due to more balanced fundamentals. But make no mistake, this isn't a coastal versus inland issue. It's about affordability, local job markets, and inventory levels. And if you're living in or planning to buy in one of these 242 cities, you need to know what kind of market you're stepping into. Because deflation isn't just a number, it's a a warning sign. Housing deflation doesn't just happen overnight, it's the result of a perfect storm. And right now, the clouds are stacked. Let's start with mortgage rates. After a brief dip in late 2023, rates have hovered stubbornly around 6.5% to 7%, with the 30-year fixed often touching the 7% mark. That's double what buyers were paying in 2021, and it's nuked affordability. A mortgage payment that was $1,800 a few years ago is now over $2,700 for the same house. Second, we're seeing a flood of inventory in certain markets. Builders are finally catching up with the pandemic backlog, and homeowners who had been waiting for the top of the market are listing. In some areas, active listings are up 20% year over year, creating a buyer's market almost overnight. Third, buyer psychology has shifted. When prices were rising 10% a year, people were afraid of missing out. Now, buyers are afraid of overpaying. That fear is powerful, and it's causing them to delay, negotiate harder, or back out entirely. Less urgency equals less demand equals falling prices. But it's not just about interest rates and inventory. It's also about local economies. Cities that rely heavily on oil, manufacturing, or tourism, industries hit hard by global shifts, are seeing job losses or stagnant wages. That makes people less likely or able to buy. And let's not forget insurance costs and climate risk. In states like Florida and Louisiana, rising flood insurance premiums are crushing affordability and spooking buyers. When monthly costs spike by hundreds of dollars, it knocks whole groups of buyers out of the market. Zillow's models take all of these variables into account, and right now, too many indicators are flashing red. This is not 2008. We're not seeing a wave of foreclosures or toxic lending, but we are seeing a reset, especially in places that ran too hot, too fast. Deflation doesn't mean disaster, but it does mean you need to be strategic, whether you're buying, selling, or holding. If you own a home in one of these 242 cities, this news might hit hard. But here's the truth. Not all deflation is a crisis. It's a correction, and how it affects you depends on your next move. Homeowners who plan to stay put, you're likely fine. If you've locked in a low mortgage rate, your payment isn't changing. And even if your home's value dips 3 to 5%, that's only on paper, unless you sell. Real estate is a long game. Historically, home prices bounce back, but brace yourself. Your home equity might shrink temporarily. Sellers, however, need a strategy. If your local market is sliding, don't chase the peak. It's gone. Overpricing your home will backfire. Buyers are smarter and more cautious now. You may need to offer concessions, cover closing costs, or accept a lower offer. Price realistically, move quickly, and understand your market dynamics. Buyers, you might finally have leverage. In many of these deflation-prone cities, bidding wars are disappearing. More homes are sitting longer. Sellers are cutting prices. That's opportunity if you can stomach the high rates. But here's the key. Buy for the long term. If you plan to stay in the home for 5 to 10 years, a short-term dip matters less. Focus on what you can afford monthly, not just the sticker price. And for investors, be cautious. The days of flipping anything and watching it rise 15% in 6 months are over. In deflating markets, rent demand becomes your anchor. Analyze cap rates, local job growth, and tenant stability. Don't buy just because something's cheap. This isn't the crash of 2008, but it is a recalibration. And in that shift, there are risks and openings. Whether you are looking to protect your wealth or build it, knowing your market is everything. Zillow's latest move isn't just a stat tweak, it's a reality check. With 242 cities now at risk of home price deflation, the red-hot housing market we've all gotten used to is officially cooling. For some, that's scary. For others, it's a long overdue opening. If you're a homeowner, stay calm and think long-term. If you're a buyer, don't rush, but don't sleep either. There are deals to be had if you know where to look. And if you're an investor, this is the moment to sharpen your numbers and watch local trends like a hawk. Because the market is no longer rising in sync, it's fracturing. And understanding which cities are deflating and why can mean the difference between a smart move and a costly mistake. Now let me ask you, do you think this is just the beginning of a broader housing decline, or is this as low as it goes? Comment below and let's discuss this topic. If you like this video, like and subscribe to keep updated. See you in the next one.